Hey everybody, Chuck Barone here, Monday, February the 6th, 2023, and we're off and running on another wacky Wall Street week this week, guys. Wow, and today was a real not a lot of data day, not a lot happening in the market, but underneath it all, lots of interesting stuff to talk about. As always, before we start the show, just want to welcome everybody to the show. Thank you guys for your support. What you guys do for us every day keeps us trucking here. We appreciate you guys. Markets today. Well, kind of a weird day on Wall Street. So stocks, choppy all day. Looked like it was going to kind of finish a little bit to the positive for the day, but it ended up going back under. Small losses across the board today. Wall Street a little bit spooked by this bond market crack up that's been ongoing now for the past 3 days or so. So Wall Street starting the week, stock market wise, lower today. Bond market, boom, another bad day on the market. Yields up again bigly, man. A 10-year up a whopping 10 basis points. 3.63%. 2-year up 18 basis points, man. This is, guys, the bond market is not really designed to make gigantic big moves like this, especially all the time. This is telling us this bond market there's just no certainty about what's happening. The market's placing bets one day, changing them the next, up 18 basis points on the 2-year to 4.48%, getting closer and closer to 100 basis point inversion. It's just the bond market not sending us good signals on the future of the economy. With the inversion getting wider now, it's telling us the upcoming recession likely will be deeper. The dollar today, with fears on interest rates, market betting now kind of against the Fed pivot. So dollar up again today, 0.62 on the index, 103.62. Dollar gaining strength with the market starting now to believe that rates are going to go higher and stay higher. Metals today had a mixed day. Gold ending up $3.40, 1,867 per ounce. Actually briefly touching 1880 today before falling back. Silver down 7 cents, $22.23. A little bit of a retreat in metals with this dollar strengthening up here. Still decent numbers though. No need to despair if you're holding gold and silver. These are real long-term holds. They're not designed to be traded, guys. So, your investment is going to pay. I think metals have plenty of room still to the upside. Oil today up. West Texas Intermediate up $1.07, $74.46 per barrel. Oil back on the upswing now. More speculation on the economy and everything else. I think it's just the market, it's just feeling its way around. Like somebody in the dark room where all the lights are off, trying not to trip over chairs and obstacles to make it to the door. Like that's kind of what the market's looking like to me right now. Just feeling its way around. Lots of uncertainty. Tons of mixed data, creating just even more uncertainty. It's fun to watch. Not a lot of fun to be a trader in this market, but if you're an investor, if you're a person that, one of the people that this show is tailored for, a person who's like not ultra rich, a regular working class guy, building your retirement, building up a portfolio for yourself and your family, just hang in there, man. This market is going to find its way, and with earnings hanging in there, with employment being super solid, there's no reason right now to be freaking over these day-to-day fluctuations. Bitcoin today, to close out the market, wrap up small today, $125 roughly, 22,993, holding strong, man. Crypto's hanging in there. Props to them, and good for our friends here, our viewers, who are holding Bitcoin and other cryptos. Now, as we do every Monday, we're going to give you guys what you can expect this week, data coming, what you might be hearing later this week that'll affect these markets. Tomorrow, we'll get the consumer credit report, which is really going to be an interesting one for me. As you remember, last month, consumer credit went up $27.9 billion Americans charged and borrowed. They're expecting that to cool off a little bit. 27.3 billion is what they're expecting. That's still an incredible number, man. You add those two together, you're talking more than $55 billion the American public has borrowed in just the last 2 months. These are just gigantic numbers. So we'll see where that report comes in. Deficit info also tomorrow. We'll get an idea of where the Treasury is as far as what did they have a plus or a minus in January? Actually, January is usually a plus month for the Treasury, so we'll see where that comes in tomorrow. Wednesday, we'll get mortgage banker index. That's expected to be down 7%. We'll also get wholesale inventories, which is an important one. This is telling you guys what producers are building up in their warehouses. An important thing to know, because what happens is not a lot of inventory. Inventory falling tends to keep prices stable or even have prices increasing. Obviously, growing inventory where they got a lot of stuff in their warehouses, they want to blow it out, prices come down. So that's an interesting number. They're expecting inventories to be up 0.1%, so pretty much not a lot happening. That's actually a better number because last month they were up 1.0. So going up only 0.1 shows wholesale inventories not accumulating the way they were just last month. On Thursday, big day, we're going to get, this is the day we're waiting for this week, guys. It's initial jobless claims. Remember the shocker? This is we're expecting 180, they're expecting 192,000. Last month we got the shocker from 188K. You guys remember that was like almost 50,000 less than they were expecting. They're expecting the unemployment numbers to go up. They went down pretty dramatically. They're expecting the numbers to be up, but only very small and significantly less than they were predicting just a week ago. On Friday, to round out the week, we'll get the University of Michigan Consumer Sentiment Report. Give us some ideas about how consumers are feeling about their economic picture and the economy overall. It's expected to be sitting at 65.1, up from 64.9. So they're talking maybe consumers feeling a little bit better about their own personal economies. News you guys need today. Interesting stuff. Not a lot of data to really talk about today, but just some interesting stuff I thought you guys might need to know that might help you guys get a better feel for what's happening. So it looks to me, guys, like our friends on Wall Street are finally wising up to what I've been saying. I've been insisting, I lived through the inflation back in the day, late 70s into the 80s. I remember when Reagan was elected president and all the stuff, even leading to his re-election with inflation and unemployment so high. It takes a long time to get rid of inflation. It never works in a straight line like it's seeming to happen right now. So I didn't, when I hear all this rose-colored glasses kind of scenarios where everything's just going to work out perfectly, I never believe that. Now it looks like Wall Street waking up to the fact that Fed rates may go higher than they want, Fed rates may stay higher and for longer than they want. So you can see the reaction on Wall Street, bond market going crazy, dollar strengthening. Money markets are now pricing and factoring in. They see the money markets peaking out at 5.1% by July. So 5.1 in a money market sounds pretty darn attractive from where it was, 0.51, right? So rates significantly higher. They're saying they're going to get there by July. Okay, that sounds great. The question then would be, how long will it stay there, right? But Wall Street finally wising up to what we've been telling you guys since this inflation. We've been talking about this inflation starting in this past summer. Don't expect miracles here. The Fed, I got to give them props. Even with their mixed messaging and their silliness, the numbers are working in their favor right now. The inflation numbers are coming down. The economy seems to be holding up, at least parts of it. So, I think there's going to be some shocks coming up. I don't have my crystal ball working for me, the Nostradamus effect, but there's going to be some shocks. There always are. And this market does not seem to be doing well with that, gyrating all over the place from bearish to bullish, bullish to bearish. Which is it going to be? Nutty crazy. Hedge funds are my favorite whipping boys. These guys, I understand the concept of wanting to be wealthy, wanting to be ultra wealthy, billionaire, whatever. But these guys give greed, and the levels of greed these guys have a whole new name, but was reading today with a little bit of glee that these hedge fund guys are now caught in a classic short squeeze. They've been betting that the market's going to go down. They've been betting on pretty big declines and having their way. But guess what? Big rally last week, especially NASDAQ, which is the short sellers' favorites, sticking these guys pretty hard. Now they're dumping these positions like crazy, covering these shorts, the fastest pace since the meme squeeze back in 2021. Remember that with the movie theaters and GameStop and this, they were selling them out, short selling, driving those stocks down. Here came the Robinhood guys, drove those prices to the stratosphere, killed those guys, billions they took in losses. Well, this one apparently even worse than that. And all I can say is, well, good. Screw them. These guys have had the best of it. So it's nice to see that, maybe they don't always get the win. They don't always get the very best, do they? Now, I got to remind you guys, when you have a short position like all these hedge funds have been doing, they're shorting stocks. What that means is they're actually borrowing the stock, selling the borrowed stock, and hoping to buy it back at a cheaper price, right? Because we know selling drives prices down, right? So they borrow these shares, they sell them, and they hope to buy them back and return the borrowed shares at a lower cost. So when there's big rallies into their short selling, how do they cover a short? Well, they buy the stock, which only leads then to more pain for the shorts, because if selling stock drives prices down, buying stock does what? Of course, drives prices up, right? So by covering their own positions, these guys are just in a cycle now that's not good. They did not have great returns for 2022, not getting off to a great start in 2023. Screw the hedge fund guys. They really wrecked real estate. And now, this one was really interesting to me. I was reading this article. They were saying that finally, even the wealthy, the what do they call them? High net worth individuals are now feeling the pinch of higher costs and more uncertainty. 58%. I guess they interviewed and surveyed 3,000 high net worth individuals. 58% of those surveyed said that they would have to work longer before they could retire. They're expecting to work longer. 36% of those high net worth people said retirement may no longer be an option for them at all. 35% of high net worth individuals said, here's the quote, that it was going to take a miracle, unquote, for them to have financial security in their retirements. Well, okay, so millionaires are going to have difficulty retiring. More than a third of them believe it's going to take a miracle for a millionaire to have retirement security. What does that say about the rest of us, man? What does that say about people who aren't millionaires? Who can't work this 4% program, right? Who don't have, family connections and family money, didn't inherit, worked hard, lived good, clean lives, raised a good, successful family, but didn't manage to put away $1 million. What happens to them in their retirement? That survey was interesting, but I think even more interesting would have been if they would have done another survey side by side with that, with working class people, and getting their opinions on would they have to be working longer and how do they feel about their retirements. I guarantee the numbers would probably be pretty shocking. Anyway, guys, that's it. Tomorrow we'll be talking about consumer credit. That's going to be the big one. How far into the hole did Americans go? $55 billion in the last 2 months. Let's see if we can get to, $85 billion in 3 months. Man, these numbers are mind-boggling. Imagine the payments on that stuff if it's credit card debt at 20%, man. Wow. Anyway, that's it for today, guys. As always, we appreciate your support. We'll be back again tomorrow with all the latest stuff you guys need to know, stuff that will affect your portfolios, your 401ks, and your psyche going forward. But we'll be here to give you guys the dirty details. Until we talk tomorrow, guys, take care. Thanks.